Hello and welcome to the Proptech Hot Seat on iPropertyRadio with myself, Carol Tallon, the show where we explore trends and technologies driving innovation across the built environment. This show is brought to you in partnership with Proptech Ireland, the hub for innovators, investors, and indeed for industry leaders. Today, I'm delighted to be joined by Duncan Kreeger, CEO and founder of TAB. Duncan, you're very welcome. Thank you for joining me today.
My pleasure.
For anybody who isn't familiar, what is TAB?
Tab is a platform online that allows people to essentially invest in fractional loan investment as well as very excitingly fractional ownership in real estate. So we allow investors to come and participate with the business that way. And also we are a fully fledged lending business in the UK. So we offer 10-year mortgages on all types of commercial assets and also short-term bridging loans.
Very good. Well, I want to break that down because we've spoken about fractional real estate, usually in more of a US or South American context. There has definitely been some resistance across the UK and Ireland. And a couple of years ago, it felt like we were getting very close to this with the adoption of blockchain, and it hasn't really transpired. So you've an interesting business model that I want to explore, but maybe tell us a little bit about your background. Do you come from kind of a finance or real estate background?
Yeah. So just on your earlier point, I think timing is everything, and hopefully, the market will catch up with other ways of fractional investment, things that you can do all over the world, which we'll delve into more detail. Short answer is to your previous questions. I've always been, since leaving school at an early age, involved in real estate. My first jobs were for estate agents in central London, and then pretty quickly afterwards, I became a regulated mortgage broker when just at the time mortgages were actually becoming regulated by the FSA at the time. So I became a regulated mortgage broker and I gravitated towards the short-term kind of property investor side of that. And soon after started my own lending business in my early 20s. So had a really good career, have personally held the pen on something like 2.5 or 3 billion pounds worth of loans, many thousands of loans, and have been through exiting my previous business and joining a private equity firm, sitting on the board with a kind of much larger business, and have all been really good experiences that have led to TAB starting in 2018.
You certainly had a broad span of a career, so I know that you will have experienced changes, but talk to me about the changes that maybe the prospective buyers, whether they were first-time buyers, home buyers, or they were indeed buy-to-let mortgage seekers that you were helping when you started. What's the experience that that persona might have in today's market compared to what they would have had maybe 2 decades ago?
Yeah, I mean, it's a really good question. I think, finding an alternative to debt is definitely a theme. So people not wanting to load themselves up with the largest amount of borrowing that they've ever considered before and being kind of locked in for many years, or even having a 25-year plan with a mortgage. I see what we're trying to do around fractional real estate is this is not a new idea. People joining together and buying a property together and sharing in the upside and the downside, joint ventures, if you will, or even the way companies are formed. I mean, it's not a new idea for people to spread their risk further. But now I think really the biggest change is access to information. So, having access to real-time information about what property values are, information around location, even the debt market, having sort of instant quotations. We live in a much more immediate information time.
I think it's really interesting that you've articulated something that I've been aware of for a decade and a half now, really. But you've articulated very well that actually there is this cohort seeking an alternative to debt. And I don't think they're just in the investment side. We're seeing it with first-time buyers. We're seeing it with retirees. We're seeing it across the spectrum. So actually, from your vantage point, being almost an insider in this, or going back historically, are mortgages a good product?
Is a mortgage a good product? Is that the question? I think mortgage, my understanding is the term is kind of death loan. That's where the term originates from. And I think in a scenario where more people want to be in the same place long term, and potentially have a job or a career that leads to retirement and then paying off your mortgage, I do think there's still a use for it. I still think it's a good product. It gives you the ability to buy something that's 10 times more than your largest purchase below, and a kind of sustainable way to see that through to the end, so that when your kids grow up, etc., etc. I think there is a distinction between, we all talk about property and its investment value and long-term values and that sort of thing, but I think we do need to make a distinction between one's own home and everything else. So it's hard to compare the two when you're comparing somewhere that you live every night and your family goes to sleep, and it's close to school, it's close to work. I think it's really important. Yes, if you buy the right property for your main residence, there are good tax advantages if it goes up in value, and those things should be considered. But really, and I don't think there is as big a drive for people to get on the ladder and to have a family home forever in the same way that maybe you did when I was a kid, and it was all about getting on the ladder. But I do think mortgages are useful and required. I just think it shouldn't be, are you suitable for a mortgage, yes or no? And if no, go and find something else to do with your money.
I think you're right to break it down into different cohorts. So let's just start with first-time buyers, with homeowners. Blank slate. If we weren't operating in the system that we're operating in today, and somebody wanted to buy a mortgage, I mean, you talk about being able to finance something that's 10 times what they would ever be able to finance, maybe in a given year. But the reality is, in Ireland, we have caps of four times your income ratio to be able to fund a mortgage. For somebody who is earning 50,000 and
what I meant by that, just to clarify, what I meant by that is your next largest purchase is likely to be a car, which might cost, say, £25,000 to pluck it up out the sky. Your house or your home is probably at least 10 times the size of that. So it's obviously, when you're buying a property, it's obviously the largest purchase you will ever do. But my point is that it is 10 times larger than the next.
And that's absolutely fair. And full disclosure, if we were doing a show about car financing, I would say that's an appalling product, because quite frankly, you're paying for a new home or a new car when you don't have a new car in year 5. So actually, I think that's a really bad product, but that's for another show, for another
same
day.
Could be said for homes as well, though. We used to talk about new build premiums.
Can it be said for homes? Because homes don't depreciate in the same way that a car does. It does. So yes, there are fluctuations, but historically over time it tends to appreciate.
I think it's an interesting point to stay on. Sorry to interrupt you.
No, please do.
When you've got a new build property, that's set up as a show home that you buy brand new and move in with your family, is obviously not brand new 12 months later when your children have used their crayons to decorate the playroom. That's how it works in my house anyway. Then I think it goes through sort of a cycle in the same way that you described, and cars are the same, because it is a bit of a passion project for me, cars. But at a certain point, the right cars will then come back in value and they become more desirable. Almost every car is, as you said, not brand new and worth less the minute you drive it away. But similar things can be said for property. I mean, depending on where you're at in any sort of financial cycle.
One of the things around a mortgage product, and I think maybe I don't know what it's like in the UK, but certainly in Ireland, I don't know if mortgage applicants are aware at how much of a position they're in to be able to negotiate. And in fact, only in recent weeks, I was watching a presentation by somebody at an Irish Rural Homes event, and she spoke about how the difference on an average home, the difference between securing a mortgage at the highest rate in the market or at the lowest rate in the market over a 25 to 30 year period could be the savings between the highest and lowest mortgage rate on just an average home could actually buy the home a second time over.
Yeah, hundreds of thousands of pounds, no doubt. I mean, they talk about it when you're investing and the compound effect of your investments growing and you earning a return. It's kind of a similar thing in reverse.
Yeah.
And if you look at the profile of a repayment mortgage, you'll see that in the early years of a kind of 25-year repayment mortgage, most of your money is going on interest. And then it sort of flips towards the back end where your interest becomes a lower portion of your payments. Yeah, I mean, small percentage points on large numbers can make huge differences.
Yeah, and well, I suppose, and look, I don't want to kind of take us too far down that rabbit hole because I'm conscious that actually in Ireland, like the UK, like in so many developed countries and in most cities around the world, we have a massive housing crisis in terms of supply, in terms of affordability, in terms of project viability to get pipelines of new homes coming through. And all of this is leading to a generation that essentially is feeling locked out of home ownership and seeking alternatives. And I think seeking alternatives today is very different to seeking alternatives 20, 30, 40 years ago, because we're in a highly regulated area in terms of planning, building type, structure, and things like that. So actually, it's not as easy to find an alternative to mainstream housing and mainstream mortgages as it might have been a couple of decades ago. So that if that's locking people out of home ownership or property ownership, or essentially a form of investment class, where does fractional ownership come in? And first of all, actually, when did you establish TAB?
So TAB was established in 2018. Just parking the whole lending side of the business to one side for the moment. The simple idea of fractional investment is to open up real estate to more people, number one. So those that don't have a huge deposit and the ability to borrow, as we previously touched on, but also trying to make it more of a liquid environment. So I think one of the big things that makes property a really big decision, apart from the price, is how difficult it is to access your capital later down the line. So if you buy a property and you change your mind after completion, there is no quick fix to accessing your capital back. You're going back on the market, your estate agent's going to show people around, they have to get approved for a mortgage, your lawyers will argue about a covenant from 1961, and then eventually you may or may not be able to buy or sell. And you've also, I think one of my big bugbears is the amount of abortive costs. I paid my lawyer and the deal fell out of bed, therefore I've lost £1,500 in legal fees and searches. So with opening up real estate to more people, the idea is that you can take a property and break it down into smaller fractions. The way that we look at this currently is to not have any debt against the property at all. So a property is all owned by the users on our platform or the investors on our platform. So really simply, you can take £100,000 property and break it down to 100 people with £1,000 each. If you own 1% of that property, you are entitled to 1% of that property's income. And we're searching for properties that have long-term sustainable income. So we're not targeting people's primary principal residence or sort of leasehold residential flats. What we're looking for is property that will stand the test of time, that has alternative uses and can easily be managed by us to ensure that it keeps producing income. So an investor can access that product from £8,000, from £1,000, and what we've always operated with at TAB is a self-select model. So we're not recommending you should do £10,000 each in all of these different properties. We present a property to market, and then people decide how much they want to invest in that particular property, and that then becomes ring-fenced against any other assets in the business, so that you could drive past a property and you could say, I own 1% of this asset and it has produced me an income for the last 3 years. And if for any reason you want to sell your share of the asset, then you can list it back for sale in the online marketplace that you bought it.
And who's investing in this?
So it's a really mixed bag, to be honest with you. We obviously have a very loyal following on the lending side, where people have typically put money into a loan for a 12-month return, and now we're offering them much longer term investments. But we're quite wide and open to working with different investor bases. We're often asked the question, kind of, who's the ideal investor? And I think where I'm at on this after many years of debating is that we actually don't know. We have a good idea of who we think it fits well for. You've got kind of mass affluent, large section in the middle that are employed with a good salary, super busy in their day job, want to diversify into real estate, want to have a passive income, but don't have the time to assess the right area, to build a relationship with an agent and a surveyor, and a lawyer. So we try to take the pain away, and then only bring assets to market that have been carefully vetted by us. And we see sort of everything from the last investment that we listed was about £2.5 million. And the largest investor had a £500,000 share, and then lots of people in the middle, all the way down to some investors having just a £1,000 share of that asset.
Are they all individuals, or would you have any institutional investors coming in?
I mean, individuals, private companies, pensions, SIPs, SASs, children's trusts, and we do have some sort of institutional capital around the business, which is very keen to support the product as it grows. What we're trying to do really is create the stock market for real estate, if you like, where you can look on our site and you'll always be able to see at what price somebody is buying or selling into a particular asset. So yeah, we're kind of different things to different people, because we're also in effect an estate agent in a very different way to how property agents work right now, which is that if you go on Rightmove with your property, typically you're looking for a buyer who wants to buy the whole asset. Whereas what we are taking that similar asset to all of our investors who aren't looking on Rightmove to buy an entire asset themselves. So we're opening up the market or the pool of buyers by a lot by introducing it to people who wouldn't be looking otherwise.
Fractional real estate is something we've explored in the past. In Ireland, there's been a few false starts. But it's something that actually we would really love to see introduced and understand essentially how it works, because the reality is we know that the wealth divide grows with people on either side, as in property owning and non-property owning. And while typically that's described as homeowners, it's not necessarily that at all. It's actually just having a share in an asset that can increase over time, but obviously, of course, it can decrease, and such is the cyclical nature of real estate. But I mean, the most recent stats we have in Ireland that is that homeowners hold 97% of wealth. So that essentially, like, renters have 3%. So
yeah, I mean, real estate is the largest asset class on earth. I think it is very difficult for people to comprehend quite how big the property market is, and that obviously spans from a large amount of property that people live in and occupy themselves, and then, as I said earlier, everything else. Places where people work, they get educated, they eat, or they buy their food and have their haircut. There's all so much real estate that quite simply isn't even on the agenda. There are lots of assets are literally kind of parked aside for institutions, for the rich and famous, I like to say, where you're not buying a big building let to Tesco unless you have some serious weight behind you. But if you club together with everybody you might be able to buy it together without the banks, and therefore sharing the income.
In terms of income, again, in Ireland, if you have a buy-to-let property, 51% of your income is going back to the government. So 51%, because of the nature it's seen as passive income, which I think any landlord will tell you it absolutely isn't. But in terms of fractional real estate, are you actually holding real estate, or are you holding shares in an investment company? How does that impact?
Yeah, I'd be very nervous not to give sort of tax advice, because it can change, obviously, jurisdiction to jurisdiction. But can even change on your personal circumstances, your family circumstances, your household income, and which vehicles you invest through. Effectively, you're receiving rent through ownership of a property that's held in trust on your behalf. So it's a very old sort of English law concept which has stood the test of time. But quite often we're asked for sort of how best should I account for the income that I'm receiving, and always my answer would be consult your accountant.
Yeah. I suppose the question I really am curious about is, again, are you part owner in property, part owner or a beneficiary of a trust, as you've just articulated there, or actually shares in an investment company? Because these are very different
Beneficial,
vehicles.
but yeah, I mean it's beneficial ownership. But you know, I know you're trying to simplify it, and I understand the question, and I understand why you're asking. But it can be, depending on, you know, for the same person investing through different types of entities, you would account for the income and even the ownership slightly differently.
How many properties do you hold at the moment, or has Tab acquired?
Yeah, so just to give you some context, since inception in 2018, we've lent almost exactly £500 million. We currently operate a loan book of of almost exactly 220 million as we sit today. So half the loans we've ever written have redeemed. On the lending side, we're just on the property ownership side, we're approaching 10 million. So, you know, the way that I've always built businesses, and it's really important to me, is to do one good deal at a time rather than to flex our muscles and show that we can do much more property. For me, really, it's about evidencing the long-term sustainability of these types of assets. And I mentioned right at the very beginning about timing, and I think timing is really, really important. So we're not sort of obsessed with having a first mover advantage or building a bigger portfolio than anybody else. We're obsessed with refining the product, listening to our customers, understanding what they like and what they don't like about, of course, the individual assets, but also our online platform, the freedom of information, the statements and what they produce. And so we're sort of constantly on this journey to try and evolve the product, all the while, hopefully, the market is starting to gain confidence, and people will quite freely invest now in wine, art, gold, and cars. And what you'll hear from me on any other podcast that I've ever done, or if you sat with me face to face, is that you simply don't buy a gold bar and put it under your bed anymore if that's your strategy to invest in gold. I can access the gold markets at the palm of my hand. I can buy, I can sell whilst we're on this call. And I see property being owned more in that way in the relative short term, I would say kind of, 1 to 5 years, really.
I like that you talk about the journey from evolution and actually learning from not just the market, but actually consumers, because again, this is a new product. And I think in that way, you fall into the same category as every startup that has moved from startup phase into scaling. So you went in with a concept, you tested the concept. What was maybe some of the biggest learning, or what surprised you during your first deal?
I think the point really is I'm kind of, more in tune with the learnings right now. I think it's really interesting. So when I started talking about fractional ownership and not having debt, having been a debt provider my entire career, people challenged me on the fact that we should leverage the properties. We would require less equity from investors and potentially boost their returns. My argument was that, if you mortgage a property to the bank, then it's not even, 50% of the income pays them, but it could be as much as all of the income pays the bank first. Now what's happened is debt costs have spiraled, all whilst I've been talking about this as an alternative to debt. And it's now much, much more obvious that we could have bought property with debt. We could have bought 10 times more property than we bought. But now a lot of those properties would be struggling to make the payments, and it would leave very, very little income to disperse. So I think what surprised me at the time was a kind of lack of long-term vision. we're also not trying to make people get rich quick overnight by jumping into complex property development deals where you can double your money. My message is about long-term sustainable income. So we bought a property that's let to Travelodge, the hotel group. We've bought a 999-year leasehold, so a virtual freehold, but the building is let to Travelodge for 18 years. So they're fully responsible for repairing and ensuring the building during that time. Effectively, it's their building for the next 18 years. And I think, one of my, I guess, frustrations is that people want to take more risk and look at kind of sexier returns when there's a really unique opportunity, I think, now to buy property at a really good price whilst there isn't an alternative to very expensive debt.
Yeah, I think it's the positioning of leverage there is quite interesting because yes, you could leverage the property, but arguably you're already leveraging the deal by bringing in the number of fractional owners. That's a form of leverage in itself.
Yeah, I mean, I would call it an alternative, and the main reason is that it's not a kind of an obligation to pay those people, but it's an obligation for us to asset manage, extract as much income, and for everybody to share in the upside. It's definitely an alternative. Give you an example. If you owned a property that had a 50% mortgage. Let's just use round numbers and say it's £1 million property and it produces 100,000 a year, which is 10%. If you had a mortgage of 500,000, you could sell half of your property to a number of people. That would raise 500,000 to pay off the bank. So now everybody owns the building together. As the original owner, I'd now own 50% of the building, but we wouldn't have any debt, so we wouldn't have anyone to pay first. And we don't have the same restrictions against what we can and can't do, and we can more accurately predict what our income's going to be moving forward. One thing it's always surprised me is people don't really know what the return is when they're investing in real estate. So they'll give you the headline gross, I'm making 5%. They're not taking into account how much equity I'm putting in and what my void periods are and what my essential repairs and maintenance costs are. So you get to the end of the year and then you can start to work out what was my mortgage debt, how much did I pay the agents, etc., etc. Whereas what we're trying to do is saying to people, look, if you invest £1,000 in this property, you will get 7.25% per annum net of all of the costs associated. We can accurately predict that because we don't have a fluctuating costs, and we will pay people on a monthly basis. So they get one statement every month which shows how much rent was collected and what their share is.
Yeah, to be honest, in Ireland, I think landlords have been really beleaguered over the past decade or so. So even if you were to just base it on the yield that a selling agent might tell you this property is capable of returning, any experienced landlord will know that the income there's just downward pressures all the time, that actually they're ending up in very little, and some are just not covering the costs at all. And for that reason, we've seen a mass exodus of landlords consistently out of the marketplace. I'm conscious of time.
Who's buying that property then?
First-time buyers, home buyers, sometimes local authorities, sometimes approved housing bodies, which are like housing associations, essentially. So we are growing our social housing base, or the property that's used for social housing, whether it's in state, semi-state, or private ownership. But where landlords exit, they are very, very, very rarely replaced by landlords. That's been consistent since about 2018. And I am conscious of time, but I'm curious about the type of property you invest in, because obviously you started in 2018. You might have had a different strategy today, post-COVID, the future of work, changing offices, the pressure in terms of building energy performance under ESG and sustainability metrics. The property market has changed. The commercial property market has changed a lot since 2018. Can you just kind of very briefly take me through where you see the opportunities for mixed use, change of use, or the type of properties you're looking at as potential investments right now?
Yeah, I mean, the first and foremost, I think longevity is really important to us. So one thing about real estate is that it stands for a long time, and it should stand for a long time, long after I'm not here anymore. There should be property on the Tab platform that's produced an income for for a long time. I think alternative use is really important for real estate investing. So not putting all your eggs in the basket of I've got this blue chip tenant that's going to pay me for 20 years. Even if they do, 20 years is a long time, and you need to have a plan after that. So my thing really is about, city centre locations where there's activity, multiple uses. So you talk about residential to commercial, commercial to residential. My thing is optionality. So it doesn't matter which it is, but it's an obvious that if this group of people leave, this group of people might be interested. We're also super interested to touch on one of your points on the environmental and social governance, looking at things that I think it's fair to say that I see two different sort of types of property market evolving. One is unloved property that hasn't been invested in, poor quality heating, lighting, poor insulation. I think those properties will get worse and worse, be harder to let, harder to sell, more expensive to refurbish, and therefore the prices will stagnate or decline. And on the flip side, you've got properties where people have invested heavily in technology, electric car charging, heating and insulation, much more a kind of more of a modern approach. And then I think those buildings will attract better tenants who want to stay longer, who want to own a share of the building that they occupy, and that will give you alternatives to what to do with the building if one big tenant leaves or if one group of people don't want to live there anymore. So yeah, hopefully that gives you a bit of an insight. We're very open to looking at types of property, because I don't think it's a one size fits all. And on the theme of how large the opportunity is, I think you need to be reactive to the market and opportunistic when things come up.
Yeah, and you're absolutely right about the opportunity in terms of non-compliant buildings in the future, or buildings that you just maybe can't continue to serve the function for which they were developed, but actually might suit another function, whether it's residential or a different type of commercial real estate in Ireland, that would fall very firmly into the brackets of coffee shops and co-working spaces. I don't know what it's like across cities in the UK.
I think London's pretty unique. Compared to everywhere else that I've researched and everybody I've spoken to from all around the world. I mean, we have American debt fund who invests with us, so we have quite a good view on the US market. People do sort of have returned to normal, I would say, in the UK, and in London specifically, more than they have in other areas. I guess what I've learned is to expect the unexpected. So it's not just trying to, understand how it feels at the moment and whether it's an area we should lean into. It's what happens if. And I think being sort of central to a high street, to a community, to an area where people sort of play in the park or eat with their children, as we both discussed, and I think it gives you optionality as the market, as it will, changes overnight one day.
Yeah, do you know what? That's probably the right note to close on. Expect the unexpected, because I think that probably exemplifies really what we've seen over the past decade. But I like the way you position it. What happens if? I think actually every innovator has to start with that and needs to return to that as well, all the time, to make sure they're looking at, they're recognizing all of the potential opportunities. So yeah, I like that. That will be kind of the mantra for today. What happens if? And I know that maybe that would more likely be viewed through the lens of risk, whereas I tend to see it through the lens of opportunity in the current marketplace.
Both. It's a balance, right? I mean, that actually is the balance here. It's risk versus reward. I think pretty much every decision in life should be, you should consult that metric of risk versus reward. And if you can get the balance right, then there's good reason to move forward.
Duncan, thank you so much for taking us through that today. I look forward to touching base with you again in another few months' time to see how this is growing and the kind of traction that you're getting, because unfortunately we know that from an affordability point of view, investing in property outright is still going to be out of reach for the foreseeable future for a large cohort of people. So fractional ownership is definitely something that's going to become increasingly attractive for certain. Yeah.
Carol, thank you so much, and you're doing a great job. So keep it up. I really enjoy what you're doing.
Good man, Duncan. That's what we like to plug at the end. Always good. Listen, thank you so much. That was Duncan Kreeger, CEO and founder of Tab. My thanks as always to producer Katie Tallon and to the audio team at Hear Me Roar Media. Before we go, just a special word of thanks to our sponsor, Proptech Ireland, for supporting the podcast and for making these conversations possible. And finally, thank you indeed for tuning in. We'll catch you on the next episode of the Proptech Hot Seat. In the meantime, please be sure to check out all of the other Irish and international real estate and construction shows here on iPropertyRadio.com.